You know, if you feel like these prop firm challenges are a rigged game, well, you're not totally wrong. But here's the thing, it's not rigged against you. It's just a completely different game than the one you think you're playing. So today, we're going to ignore the gurus, we're going to look at the cold, hard math and figure out why so many traders fail, and more importantly, how you can flip those odds in your favor.
Let's just start with a number that probably feels painfully familiar to a lot of you. A staggering 87.6% of traders failed their challenges. And look, this isn't just a string of bad luck. This points to a massive, fundamental misunderstanding of what these things actually are.
And this isn't some random number I pulled out of thin air. This comes directly from TopStep's own stats for 2024. Only 12.4% of people who try pass. Think about that. For every 8 traders who sign up full of hope, only 1 gets funded. So what is going on here? Why is that number so dang low? Well, it turns out most traders are falling into the exact same trap.
And that brings us to what I call the trader's trap. See, we're all taught to go out there and hunt for alpha, right? It's just a fancy Wall Street term for having an edge, a strategy that can consistently beat the market. But here's the rub. In hyper-efficient markets like futures, where all the information gets priced in almost instantly, real, true alpha is incredibly rare. So if you're using a strategy designed to find some magic edge in a normal market, you're bringing the wrong tool for this very, very specific job.
And here's the kicker. A lot of those popular strategies, the super high risk to reward ones you see all over YouTube, are, and this is a quote, the exact mathematical opposite of what actually works here. It's like you're trying to hit grand slams in a game that's won by consistently hitting singles. This idea right here is the key we need to unlock this whole thing.
All right, so here it is. The big secret, the reframe that changes everything. You have to stop thinking of this as a trading contest. A prop firm challenge isn't a contest. It's a financial instrument. It's a structured product with a very specific and kind of weird set of rules. And once you see it that way, oh man, the path to winning gets so much clearer.
The key concept we need to wrap our heads around is called a convex payoff structure. I know, it sounds super academic, right? But stick with me, it's actually dead simple. All it means is that your potential loss is capped. It's strictly limited, while your potential gain is huge. In a prop firm challenge, what's the most you can possibly lose? The entry fee? That's it. But your potential win? A funded account worth thousands. It is a completely lopsided bet, and it's heavily in your favor if you play it right.
Okay, this slide just lays it out perfectly. In your own trading account, if you have a $3,000 drawdown, that's a real $3,000 loss from your pocket. But in a challenge, if you hit that same drawdown and fail, you only lose the fee you paid. Let's say it was 49 bucks. Your downside is capped, but the upside? That's very, very real. A $3,000 profit target means you've made $3,000 in cash. Your losses are tiny and fixed, but your winnings are real. This right here is the lopsided bet we are here to exploit.
So if that's the game, what's the strategy to win it? Let's just ditch the myths for a second and look at the actual data. We're going to see what happens when we throw a few different trading styles at this thing. Because that's what it is. It's what's called a barrier problem. All you have to do is hit the profit target up top before you hit the drawdown limit on the bottom.
First up, the classic home run strategy, a 4-to-1 reward to risk ratio. This is the one all the gurus preach. And the pass rate? About 37%. Now don't get me wrong, 37% is way, way better than the average trader's 12%. But we can do better, a lot better.
Now what happens if we dial it back a bit? We go for a more balanced 2-to-1 reward to risk. And look at that, the pass rate climbs to 40%. It's not a massive jump, but do you see the trend? Reducing that home run ambition is actually making us more likely to succeed.
And boom, here's the punchline. This is where it gets wild. What if we flip the entire script and use a high win rate strategy? One where our average win is actually smaller than our average loss. The pass rate climbs again to 41%. Now, this probably goes against every single thing you've ever been taught about trading. But look, the math doesn't lie.
So what's the big takeaway here? It's crystal clear. For this very specific type of puzzle, a strategy that focuses on a higher win rate and just being consistent, even if it means taking smaller wins, gives you a mathematically greater chance of passing. We're not buying lottery tickets here, we're just trying to stay in the game and steadily grind our way to the finish line.
All right, so we get the math now, we see the problem, so how do we actually solve it? Well, it requires a pretty fundamental shift in how you think about trading.
We have to move away from hunting for those big, risky wins and instead focus on stringing together a bunch of high-probability, smaller wins.
So what does this winning approach actually look like? Well, you're focusing on a high win rate. And that means you have to be okay with accepting smaller wins. You're prioritizing consistency, which creates a nice, smooth, low-volatility equity curve that just steadily climbs up. And you have to treat this exactly for what it is, a barrier problem. Your one and only job is to get over that green profit line before you touch the red drawdown line. That's it. Nothing else matters.
And the difference this shift makes? It's not small. It's massive. By adopting a simple strategy that fits this profile, one that might not even be profitable in a regular account, you can get your pass rates up near 50%. Remember where we started? The average trader is at 12.4%. You go from being in that failing 87% to having almost a coin flip chance. That is a 4x increase in your probability of success, just by understanding the math of the game you're actually playing.
Okay, passing is great. But let's be real, we're all in this to make money, right? That's the real goal. So to figure that out, we need to calculate something called the net expected value of our attempts over time. It's just a way of figuring out if this whole thing is actually worth your time and money. So how do you figure this out for yourself? It's actually a pretty simple 4-step formula. First, you got to know your past probability. What are your real odds of success with your strategy? Second, you have to be totally honest about your costs. That includes the challenge fees, any activation fees, and maybe even a few failed attempts. Third, what's a realistic payout you can expect from a funded account? And finally, you just put it all together. Is what you could potentially win, multiplied by your odds of winning it, greater than what it costs you to play? That number is your net expected value.
And just to give you a quick example of what that could look like, let's say in a pretty pessimistic scenario, it costs you about $300 on average to get funded once you factor in a couple of tries. But the average payout from that funded account could be somewhere around $800–900. Well, that leaves you with a net profit of $8,600. That is the power of playing the odds correctly in a system that has this kind of convex payoff.
So I'm going to leave you with this one question. The next time you take a prop firm challenge, ask yourself this. Are you trying to be a market wizard who can predict the future? Or are you a strategist who is simply playing the odds of a unique financial product? Because one of those is gambling, and the other is a business. And the answer to that question will absolutely determine your results.